Hi, I'm Kara Murphy, and this is Money with Murphy. 2024 was an eventful year across many areas of the economy and the markets. We had a presidential election with more than a few surprises. Inflation slowed, though continued high price levels agitated consumers. And equity indexes soared for the second year in a row, driven again by a small handful of names. Stay tuned as we take a quick look back on the year. I think for anyone with a diversified portfolio should not be worrying about elections. What we find is that in election years versus non-election years, the S&P 500 return tends to be the same. What is different is how you get there. Typically, those returns tend to be in the back half of the year, and you have a fair amount of volatility in like August, September. But it's really important to remember that markets tend to take off actually before the election happens, so you don't want to wait around for the actual event until you buy in. When we look at data, there is a very clear and direct correlation between how people vote and how they feel about the economy. So if you look back, for instance, to the Reagan administration, Republicans reported feeling much, much better about the economy than Democrats. And you see this pattern replicated over decades. And, when Obama was president, it was the reverse. Tariffs, especially of this size, would likely change the behavior of consumers, businesses, and other countries. For instance, if all imported goods are more expensive, consumers may simply buy fewer goods. Businesses may try to find cheaper inputs that are made here in the US, or they may choose some combination of increasing prices or accepting lower profits. Our trading partners are unlikely to accept tariffs without some sort of retaliatory measures. If you hike your tariffs, I'll hike mine. As a result, US manufacturers may have a harder time selling their wares overseas. Finally, while it's difficult to predict exactly how behavior may change, tariffs, if implemented as Trump has suggested, are likely to increase inflation. If you think about where the market's been so far this year, we have the S&P 500 up about 10% so far this year. And in the meantime, Fed expectations for cuts have gone from 7 cuts at the end of last year to 1 or 2 today. Normally, you would think that would take a lot of wind out of the sails of equities. But as that's happened, economic growth has been stronger, corporate earnings have been stronger. So what we're finding is that there's some really good fundamental underpinning for the strength in equities. So yes, it might be a bit of a disappointment that we don't get the Fed rate cuts, but the fact is the economy just doesn't need it. Just 2 years ago, prices for everything from steak to gas to sofas were rising at a pace not seen for decades, eating away at Americans' take-home pay. Since then, with help from higher interest rates delivered by the Federal Reserve, those price increases have abated, though not quite to where policymakers would like them to be. In previous rate cutting cycles, going back to 1984, mortgage rates only dropped around 0.5 percentage point on average, despite much larger drops in the Fed funds rate. In some past cycles, mortgage rates even stayed flat or went up after the first cut. So while we might see some decline in mortgage rates going forward, they won't necessarily keep pace with the Fed. So the Fed is actively trying to pivot, right? We had our first rate cut in quite a while, and that introduces a lot of cross currents into the market. And so it makes sense that the economy is going to kind of, chunk around for a little bit. So yes, we could see a reacceleration. I think the Fed will then, start to pull back a little bit. But this lag issue in monetary policy is a really big challenge. So it's sort of been a slow story that over the last couple of months, we've been seeing a broadening out, as you suggested, in the market. And in fact, if we go back just 4 weeks ago, we had about 65% of names in the S&P 500 running above their 200-day moving average. Today, that's running closer to 80%. And then when we break it down by sector, in fact, within every sector, at least 2/3 of the individual names within those sectors are also running above their 200-day moving average. So this is all a good sign that it's not just the Magnificent Seven that's earning these gains. We're seeing other parts of the market participate as well. In the second quarter, the S&P 500 climbed about 5%, clocking in a 15% year-to-date return. During that time, the market has grown even more concentrated. Tech stocks were the big winners, and the Magnificent Seven now make up 34% of the S&P 500 on a market cap basis, up from just 29% at the start of the year. Those 7 stocks have contributed more than half the return of the index over the last 6 months. It's pretty incredible in that you continue to see Magnificent Seven with this great earnings power going into 2025, but still not as great as what we've seen in the past. And at the same time, you have the rest of the market that will start to accelerate earnings. I mentioned that They have flat earnings this year, probably this quarter. Into next year, we start to see double-digit earnings. So there's this big shift, and there has to be this handoff from the guys who have led us here and to what happens next year. This year has been chock-a-block full of both challenges and rewards. We appreciate you joining us as we dive deeper into key themes in the markets and the economy. And as always, invest
wisely,
and live
richly.
richly.
Happy holidays from the Kim team.